I'm here with Roy Keenan, co-head of Australian Fixed Income at Yarra Capital. Roy, thanks for joining us at the Insider Network's Income and Defensive Assets Symposium 2024.
It's a pleasure to be here.
Great. What are the key themes that are influencing your portfolio construction in the current environment?
Look, I think it's no doubt what inflation the central bank's going to do in the coming meeting. I think for us, it's about, we're in this process of thinking about the markets as being high for longer. So how do we sort of, obtain that quality income? And how do we sort of think about, how the economy is going to play out off the back of any RBA response in the sort of coming 12 months?
Very good. Can you elaborate on how leveraging credit and hybrid securities within portfolios can help in generating regular and stable income streams?
Look, I think it's really important to, think about the sort of environment we're in today. And we're sort of thinking about this higher for longer environment. We sort of want to be up the risk curve in credit quality. And I think, particularly hybrids today, hybrid securities, whether in tier 1, tier 2, I think that added yield and income you're getting for it, for probably that step up in risk that you're taking and moving into hybrid securities is a really good risk return trade-off. And I think, floating rate credit, in major bank A- tier 2 paper, triple B, tier 1 paper, I think it's a pretty nice place to be for investors. From a credit point of view, we still like triple B credit. We like RMBS securities at the moment. We think you're getting paid very nice spreads for the RMBS market. But the combination, I think the most important thing is, you don't want to be focused so much on just one sector. You want to build a nice diversified portfolio of securities. And I think there's a lot of alpha opportunities out there at the moment. And, it's an environment I'm pretty excited about.
Yeah, it was fascinating to see the aggregated default risk percentages for each of those different classes of bonds there. How does utilizing an active management approach allow you to exploit inefficiencies in the market?
I think it's everything. Look, as an active manager, I think there's a period for passive investing, and I think the time for passive investors passed. So I think it doesn't matter if it's equities, fixed income. I think we're moving into a couple of years, the next 2 to 3 years environment where an active manager is going to outperform. From me, I think the most important thing for us is, we want to get paid for the risk we're taking. And if we're so focused on that, getting paid for that risk, then we're sort of constantly thinking about our opportunities and turning the portfolio over. We're not big turnover in portfolio, but once a security is not paying you for the risk you're taking, then you should be looking for other opportunities. And I think having a fund that is, has that ability to actually move around the credit spectrum is really, really important.
Now, one of the key questions that clients in retirement have is the extent to which their capital is secure. How do you think about capital protection across the portfolio?
Look, I think, if you're talking about IG, it's everything. You're talking about high yield, it's everything. I think from a fixed income point of view, especially if you're doing your own internal credit work, which we do at Yarra, it's the number one thing we think about. We want to get our coupons and our money back. And it doesn't matter if it's in the credit quality of the company or the structure that we're investing in. Structure and documentation is just as important as the credit work in our view. So, as I often say, fixed income guys, we want our money back. Equity guys, they can have the blue sky. I think that's really, really important. Once you move up and down the credit cycle and you move into a higher yield framework, of course you want to protect your capital, but there is going to be pitfalls, and we know that high yield has default cycles.
And that's why you diversify your bond grades.
Absolutely. Yeah.
Exactly. Very good. Last question. What could be the biggest surprise for markets as we move into the back half of 2024?
Look, I think probably for us, if I think back 12 months, I would have said inflation. But I think we're now at that stage where everyone agrees inflation's trending down. So I think the key from a credit investor's point of view is where could things go wrong from a growth perspective. And I think if I look sort of 12 months, and this is not our base case, I'll stress that, but I think if you look out 12 sort of months, the risk is that, growth could come in on the lower side. And that could be from a change in government policy on immigration, or it could be, just a general slowdown and the higher interest rates that we've had. The good thing for Australia's point of view and why we like Australia versus to global credit is fiscally the government can support the economy. And more importantly, I think we're going to have a sort of inflation outcome where the RBA is going to start cutting rates, which is pretty positive from a credit investor's point of view.
Very good. Roy Keenan, thanks for joining us.
Thank you.